there's a very simple rule of investing I follow, which is never ever invest in any IPOs. And it hasn't hurt me over the decades following that rule. And there's a number of reasons why that should be the mantra for most investors. So first of all, an IPO is a company selling shares into the market. The company controls the timing. The company controls the story. The company has a lot of control over many factors, and they're optimized to maximize the proceeds that the company is going to get. So if the IPO market is hot for consumer non-durables, you're going to see a lot of consumer non-durables come out at that time. And so one of the big advantages we have with equity investing and investing in the markets is that these are auction-driven entities, and auction-driven entities tend to basically tend to give us pricing that goes to extremes. At times it gets very euphoric, and at times it gets very pessimistic. And as an investor, you can take advantage when things get pessimistic, and usually be a seller when things get euphoric. So, for example, I mentioned, the real estate firms at 1/4 of liquidation value. If I went to those promoters last year and I said to them, listen, I want to buy 25% of your company or 10% of your company or 1% of your company, would you sell it to me at a 20% premium to your current stock price? They would just laugh me out of their office and say, get lost. They wouldn't be willing to sell it to me at 5 times the price that the stock was trading at, because they know what it's worth and they know it's undervalued. So the beauty of the stock market is it allows me to buy those stakes without having those conversations with those promoters. And that's the only reason I was able to buy those stakes. So same thing with Rain Industries. In 2015, the company would not be willing to issue equity at those prices. They would have never issued equity at those prices, but they didn't need to. You could just buy it from unsuspecting adults in the market. So a simple rule to follow is do not buy what is being sold, especially what is being sold by promoters. So just completely sidestep the IPO market. And the second is, you mentioned insurance. Clearly, India has a number of areas, insurance, banking, asset management, and so on, that will grow a lot. They'll grow at multiples of GDP growth, and GDP growth itself will go through a lot. But the investing game is not so much about these macro themes. It's getting down to a specific business. So you have to identify businesses where management is not only honest, they're highly competent, and they're going to go for it. They're going to go for the growth. The second is you have to go for businesses where there are strong tailwinds and which are producing and gushing cash, producing a lot of cash. And when you get that combination at a good price, at a reasonable price, that's when you step in. And the rest of the time you do nothing. So the most important thing after getting fluency on compounding is to have patience. We will not find investments every day or every month or every year. I mean, if you talk to me right now, I can hardly find anything to buy in India. I mean, there's 5,000 companies traded in India. I can hardly find anything to buy. And that's not a tragedy. It's perfectly fine. There will come times in the future when we have plenty of opportunities. And the important thing is when those times show up, to have the will and the resources to act on it.